Hello and welcome to Scylla Consciousness. I'm your host, David Rothkopf, and this week, as every week, we're going to look at a different dimension of AI with an expert who can provide us with insights we think you'll benefit from. This week, we are extremely fortunate to have with us Andrew Lowe, who is the Charles E. and Susan T. Harris Professor, a professor of finance and the director of the Laboratory for Financial Engineering at the MIT Sloan School of Management. Professor Lowe's current research spans four areas: evolutionary models of investor behavior and adaptive markets, artificial intelligence and financial technology, healthcare finance, and impact investing. Welcome.
Thank you. Good to be here.
We are really glad to be able to talk to you because one of the things we're trying to dissuade people from is the kind of overgeneralization of what AI is or is not, and to look more at sort of applied AI and how it may impact lives. And I know you've covered this from a variety of perspectives, but where I'd like to start, if it's okay with you, is on your thinking about the role that AI can play in finance and in particular in investing. I've read some of what you have written in this regard, as I'm sure many of our readers have, talking about how you think within a few years AI can overcome the hiccups and hurdles it faces at the moment and actually provide not just useful financial advice, but perhaps even active hands-on or virtual hands-on uh, investment management. And so perhaps you could give us an overview of your thoughts in this regard.
Sure, I'd be happy to, although it's a pretty big topic. So I
Well, we
think,
have time. They rather hear you talk than me. So go on.
okay. Well, first of all, I think that investing is also a very big topic. So maybe we divide it up initially between professional institutional investors and then retail investors, the rest of us, because the answers about the role of AI in each of those can be quite different. For example, when it comes to professional institutional investors, they are already using AI. In fact, they've been doing it for now many years, different kinds of AI. And in that context, I think there's no doubt that generative AI, large language models, and so on add a tremendous amount of value, even right now, in being able to bring together lots of different kinds of data sources and integrating them in ways that make professional managers more productive at their jobs. So that's already happened, and it's going to continue happening, and the technology will continue spreading. The more difficult question is whether or not AI can help the individual retail investor. And here it becomes a little bit more tricky because retail investors have varying degrees of expertise. And for those who are very, very motivated to learn about different kinds of investment styles and theses and different sources of information, AI can play the same role that they play for professional institutional investors. What gets more murky and potentially dangerous is where retail investors who do not spend the time learning about investments, when they simply assume that AI can be delegated to make investment decisions on their behalf. And that we're not ready for right now. I think one day we will get there, but that one day is at least a few years away. And we just need to be careful in warning people not to take everything from a large language model regarding investments at face value, but to be able to ask questions, to talk to professionals, to talk to colleagues, and to really think carefully about using that information in the right ways.
Yeah, it's a problem we've seen in other applications where, to pick one that is not even in any way close to this, people who use AI for targeting weapon systems, say at the beginning, okay, we are not going to rely on the AI. It's just a tool to support us. But when it's found in practice, after a while, that's exactly what they do. They just say, "Oh yeah, that's not bad. We did pretty well yesterday. I'm going to let it do a little bit more of the work." And so there is this kind of inclination to think, "Well, we're close enough. This will make my life a lot easier if I just trust it." How do you deal with that other than repeating your message over and over again?
Well, I think the way to deal with it is to describe the process by which one can develop trust for AI. And so trust is a really, really important concept. I always say, even before the advent of these large language models, that trust in any context, specifically in human contexts, trust needs to be earned. It should never be freely given. In the same way that it may take years before you learn to trust somebody enough to marry them, to have children with them, to engage in a business startup with them. I think that we have to develop that level of trust with using AI. And it's actually not that different from human interactions. How do you develop trust with another person? Well, you spend time with them, you see how they react to certain situations, how they react to you, and over a period of time, whether it's weeks, months, or years, you will develop a sense of trust for that individual. I think the same applies to large language models. We need to have experience in working with them over a period of time to see what their strengths and weaknesses are, to see areas where they can really hurt us badly if they make certain mistakes. And I think over time, we will get experience with these AI. And at that point, we will then be able to transfer more and more trust to them. But it's the kind of thing where you need to take it slow initially. And little by little, as you learn more about that kind of AI, you can then make that decision, that informed decision on trusting them more.
Yeah, well, it seems very likely that as we go forward and we get to know AI, we're going to demand different things of it, right? So at the front end, when AI seems to be super new and interesting as it is now, for a lot of people, not people outside the AI world, uh, there is this sense of, well, how much compute? How fast? How big is the database? What about all the technology, bells and whistles inside of the thing? But this issue of trust, there's a big, of all the value added you can hope for, particularly in this kind of application, it's of the greatest um, importance. And it requires a bunch of things. It's not, some of it's in the algorithm, some of it's in the database, some of it's in the size of the database, some of it's in the specificity of the database, because obviously investing is not just institutional investors and individual investors. Investing is many categories of asset that have different factors impacting their prices and different risk drivers and different value drivers. And so I would imagine trust will be greater the narrower the scope in some respects of the financial AI model. But am I misreading that?
No, that's exactly right. But I would add one more aspect to it. It's not only just the narrowness, but it's also the particular context. So there are certain contexts where it's actually pretty easy to trust an AI. For example, if you're trying to understand what the costs and benefits are for target date funds, those are a very specific kind of mutual funds that investors might be interested in for planning their retirement. I would trust an LLM to put together a list of their properties and maybe even to put a survey together among the various different providers to see what the strengths and weaknesses are of different target date funds across these offerings. But that's very different than delegating the decision to put half of your retirement wealth in a specific target date fund that an LLM recommends. That I would not do right now. And so part of the way that we develop trust is to understand how these LLMs behave in different contexts. Context matters a lot.
Yeah. In fact, there's also AI context, which is something new to a lot of us. And Each of us use it in different ways in our daily lives. And I find that when I'm doing research on an issue, something I'm writing about or talking about, I'll often go to four different AI providers, four different models, and ask the same question to see what the differences are. And I don't know if there's an equivalent in this regard, but the algorithms are different, the databases are different, the timeliness, the information is different, and it seems salient, and it seems like a common sense approach. Does it translate?
Absolutely. I think there is wisdom in the crowd, and the question is how big the crowd needs to be. But right now, certainly the three or four most popular AI providers right now can offer very, very helpful diversity. I think each one of these AI platforms provides you with a different set of information and perspective. But in the end, I think when it comes to something like investing, ultimately humans still need to be the ones making decisions. We're not yet at the stage where we can simply delegate the management of our retirement assets to any algorithm or AI, no matter how sophisticated. I think that that day will come, but it's only going to come if we spend enough time with these AIs and understand what their strengths and weaknesses are, and be able to deal with those weaknesses in the context of human decision making.
Yeah, one of the other things. I mean, I'm old enough to remember. I worked many years ago in that industry for institutional investor and other organizations, and life was pretty simple back then. There were a certain number of asset categories, and there were a certain number of philosophies. And you might be a value investor, you might, be a market timer. It was never very respectable, but you might be a market timer. You might, take a different approaches. Over time, new insights have emerged, like behavioral economics and so forth. And I know you've done some work in that area. Is AI helpful? Is it keeping up with being able to look at some of these kind of uh, 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 other factors, these other drivers of value? Like, you mentioned the wisdom of crowds, but yeah, I've read some of what you've written about. You talk about issues like emotion in markets. Can AI account for that? I mean, it's AI is pretty logically based right now. It doesn't really do, we call it in artificial intelligence, but we don't really see it do a lot in creativity, but it also doesn't do a lot in terms of emotional issues.
So, you've put your finger on one of the biggest aspects of AI that is both missing and where there's the greatest opportunity. Typically, humans interact with each other based upon a variety of different cognitive faculties. But one of the most important is emotion. When we talk about having a connection with somebody, rarely does that connection refer to a particular intellectual perspective. We may be both aficionados of a certain kind of art. We may enjoy listening to certain kinds of music. But when we talk about bonding with another human, it is almost always emotional. At least part of that experience is emotional. And so right now, we don't bond in the same way with AI, largely because that aspect of interaction is missing. But it doesn't have to be missing. There's a lot of research going on, both in behavioral economics and in other fields where we study human emotion, where it is possible to effectively program that component into AI. We can endow AI with certain abilities to emote and to be able to interact with others who are in the process of feeling various kinds of emotion. And if that happens, that changes everything with regard to our relationship with artificial intelligence. The great Marvin Minsky, one of the founding fathers of the field of AI, he was once quoted as saying, I don't want to build a computer that I can be proud of. I want to build a computer that can be proud of me. And I think that's what he was getting at. He was getting at the ultimate source of human connection, which is to be able to feel like you need to be interacting with another entity, whether it's human or silicon based. And so we're not there yet, and there's not that many people working on it. There are some, um, but I think that at some point, if we are able to endow AI with enough emotional intelligence, EQ, to be able to interact with us on our level, that will be a transformative inflection point for the entire field.
Yeah, there is a flip side to it, of course. And that is that a lot of the delta between high performers and people who lag the markets, or to put it another way, a lot of the sort of uh, the source of alpha that investors look for has to do with market inefficiencies, right? Ignorance it can be a source of it. Emotion can be a source of it. Uh, and you can imagine that right now it's ironic we're having this conversation, because if you go to the Wall Street Journal or Bloomberg or whatever right now, it's all about how do you feel about AI stocks. It's kind of right as it happens right now because they're driving the market. But you could also imagine a moment. I don't know whether it's now or 5 years from now or 10 years from now, where things are assisted enough by AI that these sources of alpha, different performance between different players, are gone because AI makes markets much more efficient. Have you taken that into consideration? What thought about that?
I have, and I think that you bring up a good point, which is that the smarter we get, the smarter investors get, the more efficient the prices are that are generated. Gene Fama, one of the authors of the efficient markets hypothesis, defines market efficiency as when prices fully reflect all available information. And therefore, the smarter the investors that are in any given market, the more likely it is that the prices will reflect most, if not all, of the information in that setting. And certainly with AI agents, with various kinds of bots that are scraping the market and engaging in these agentic type of relationships, you can easily see how a market becomes very, very efficient, hyper efficient, in fact, with the exception of the fact that part of what AI is also doing is doing our bidding. And when humans are involved, emotion is not far behind. You'll always have an emotional component as long as humans are engaged in these kind of transactions. And even if it's the AI trying to maximize the welfare of a human, if the AI knows that humans tend to panic when markets go down and they tend to get over exuberant when the markets go up, if they take that into account, effectively they're taking emotion into account. And that means you're going to see emotion reflected in market prices. Also, different AI have different approaches to these various kinds of decisions. So there'll be some diversity there as well. So it won't be just information exposition that these various different agents are involved in. It will also be using their different sources of information, different perspectives, different algorithms that were programmed into them by their human authors that will elicit a certain amount of diversity among these ecosystems of agents. So I don't see this as the death knell for behavioral finance. I think that you're going to see, even as we speak, you're going to see these kinds of bubbles developing and bursts happening over time, as long as humans are involved. If one day we take humans out of the equation, then I don't know. I'm not sure what you'd see in that case.
Well, I mean, one thing that you might see in that particular case is that the differences between investment strategies or investment mandates drive differences. So if somebody is on a very uh, uh, trade centric now strategy, you may look at a stock one way, and if somebody's looking to take the oldest example in the world, for 51-cent dollars over a 20-year period, they might look at things completely differently. And the tension between dozens and dozens of those approaches may create arbitrages that investors then want to take advantage of, presumably.
That's certainly possible. But let me give you an example that I think may shed some light on this. It's a little bit of a brain teaser. So, if you take a relatively straightforward task like opening and closing a garage door, there are not too many ways of doing that now. I mean, we've been through various different kinds of garage doors. Some open on the side, some roll up, and but if you think about one piece of tech that many of us who live in the suburbs make use of every day, it's the automatic garage door opener. And frankly, there's just not that many different types of garage door openers because that problem's been solved. And we know what the optimal version is. And so that's the version that everybody uses. But here's an interesting fact about investments. I wrote a paper recently where I just looked at the different investment styles that came and went over the course of the last 100 years, from 1920 to 2020. And I made this really beautiful timeline, beautiful from my perspective because I created it, so I'm biased. But the various different types of investment styles. You've got the Graham and Dodd investment style. You've got Harry Markowitz's portfolio theory. You've got a variety of other types of investments. What's odd about this 100 years of the evolution of investing is that every single style of investment that was introduced since the 1920s still exists in one form or another. It's not like the garage door opener where all of the earlier versions went by the wayside and there's just one way to open a garage door. There are many, many ways of investing. And so that tells me that there is something different about investments that we don't know the only way to make money. There are many, many different ways of making money. And so there's diversity built into the process, which comes from the complexity of the process, but it also comes from the complexity of human cognition as we perceive the world around us and what that implies for the value of a particular company that trades on a stock exchange.
Yeah, and I mean, part of that then manifests itself in investment missions, and of course, a 25-year-old is investing in a different way than a 75-year-old, or corporation is investing in a different way from, uh, uh, a government, national government, and so those do create these other kinds of outcomes. But one factor in the emotional study of markets, and I, by the way, I wish this conversation could go on and on. I'm finding it fascinating, and I hope we'll be able to get you back at some point. But one factor in all of this that I don't want to leave without touching on, in sort of the emotional view of markets, is greed, because of course some people want it all. We live in a world in which we've seen a guy say, "Oh no, I need $1 trillion to be properly compensated for running my business," and we've got 1,100 billionaires in America, and they have more money than they will ever need in their lives. So, sort of a rational calculus is not really what's driving that. What we've seen in markets in the past, what happens? Big investors with a lot of money get the best tools so that they can be one step ahead of everybody else. And, it's led to the whole change in the nature of Wall Street over the course of the past 30 or 40 years, where there are many, many more people who are seeking a millisecond advantage in their trading strategy. And so they'll invest in technology and so forth. Well, presumably that's going to happen here. Presumably, the biggest, best investors are going to get the biggest, best tools with the most compute and the greatest access to energy and the minds of people to interpret it, and that um, uh, people updating algorithms and updating chipsets and they're going to be ahead of everybody else. And they're not going to say, once they have that, "Oh, by the way, this is available to you at your corner store for $5," right? They're going to say, "I'm going to keep this because I'm going to get more of the market." And so one of the questions, and I think it's a question about AI in a variety of different areas, is, can you foresee AI driving inequality in market outcomes? so that the haves have more and the have-nots have less?
I think certainly that's a concern. And I think there are other areas of life where AI can have an impact on inequality. But I actually think about it the opposite way when it comes to financial markets. To me, AI can democratize access to all sorts of financial instruments and information that before the advent of large language models, the retail investor didn't really have a chance of being able to access. For example, uh, institutional investors are able to combine and integrate very, very large data sets into their financial decisions. And before the advent of large language models, if you were not a machine learning expert and you did not have feeds to 150 different data sources that Fidelity or Vanguard or BlackRock had, you were at a major disadvantage. But now, with the large language models that we have access to and with the data sources that they themselves have access to, these LLMs, the retail investor can simply say, tell me all the news that is relevant for Microsoft stock today, and you'll get delivered on a silver platter. Now, you have to be careful that the information is accurate and that it hasn't been the product of any kind of hallucination. So it does require still a certain set of skills and due diligence. But we now have technology that has been given to retail investors. And I think that allows them to engage in more sophisticated kinds of investment strategies that has ever been possible. Now, let me follow that up quickly by saying that most retail investors are not interested in, nor are they equipped to be able to do that. But every once in a while, you know, here, obviously, I live a privileged existence being at MIT, but every once in a while, I'll run across an undergraduate who has been investing since they were 9 years old. And now they have access to these tools, and they've done incredibly sophisticated analysis just on their own, with their own laptop, logging into various kinds of chat rooms and using freeware that's available to anybody. That, in my view, is a democratization of the financial sector that really didn't exist prior to LLMs. So I think that there's always going to be a bit of a financial arms race when it comes to technology. And it is true that those who are well armed with lots of data, lots of compute, can do more than the rest of us. But financial markets, by their nature, are accessible by anybody. You and I can place a trade right now for any stock that trades. And that level of access, it doesn't exist in many other industries and in many other fields. So I believe that the era of innovation for individual investing is really just at the very early stages and will continue to grow.
Well, as we're recording this, we're entering the holiday season. And so I appreciate your kind of warm view on this, although frankly, your story of 9-year-old investors make me wonder where I went wrong with my children. I also must say, then this is just maybe my own cynicism, that when I listen to the story, and I've worked in this sort of space for a long, long time, it does remind me a little bit of the joke about the two guys and the bear, where the one guy, they say we both have to outrun the bear, and the other guy says, no, I just have to outrun you.
That's right.
And so if you're a big time investor, you may say, well, it's great that this rising tide is lifting all these boats, but I just have to stay 1 second ahead of these people in the trade, and I'm going to beat them. And so, which of those two factors wins out, who knows? Because I think everybody also has this supposition that they can stay 1 second ahead of somebody. And so there is an opportunity to cash in on that. Anyway, there's a lot more here to talk about. I encourage everybody to go and look at Professor Lowe's work, follow it closely, and with some luck, we'll be able to invite you back and continue this conversation. For now, thank you very, very much. And thank you, everybody, for listening. We'll be back next week with more Scylla Consciousness. Bye-bye.
Thank you, David.
This podcast is underwritten in part by the U.S. Embassy of the United Arab Emirates. Its editorial content is completely independent and the views expressed are exclusively those of participating experts. It is presented live, without editing. For further information about the UAE's efforts in the areas of artificial intelligence and technology, go to the website of the embassy at www.uae-embassy.org and search for UAE-US Tech Cooperation. We thank them for their support. We thank everybody who's supporting this podcast for their support, and we look forward to it developing and growing over time because the issue is so important.